So, continuing our discussion of dividends, let's talk about some other ideas or concepts that might give us some indication of what investors are really thinking about when we talk about distributions. The first concept is something called the clientele effect. Essentially, different investors have different payout preferences. Retirees often prefer stable dividends, while young investors may prefer firms that reinvest for growth. Once established, a company's historic payout policy locks in a certain clientele. Making any abrupt policy changes is costly. For instance, if Coca Cola cuts its dividend, it could alienate long term income investors. What happens to value when a company changes its dividend policy? The current investors are unhappy and everybody would want to sell. Now, normally we would say that the price would fall because demand is falling. But there are other investors that like this new payout policy, so the demand would simultaneously increase. So the net effect is there's no change in price. So the clientele effect gives some credence, if you will, to the idea of Modigliani and Miller that the payout policy really doesn't matter. The signaling hypothesis talks about information. So dividend changes send signals to the market. Initiating or raising dividends signals confidence in sustainable earnings. Cutting dividends signals distress. Microsoft's first dividend in 2003 signaled maturity. General Elective's dividend cuts during the 2008 crisis signaled weaknesses. These examples show how markets interpret payout changes as indicators of firm health. Managers do not want to reduce dividends since they know that investors would see this as a bad signal. They are sending us information that something bad has already happened or will happen. We need the cash to cover this bad event. If they increase dividends, however, they're saying something's going to happen to make that payment easier, more convenient to be paid. So the concept is not that the change in dividends that changes value, but the information that's provided to investors is what is changing the value of the firm. Another idea or concept is something called the residual distribution model. How this kind of follows the idea where we sometimes refer to shareholders as being residual owners. They only get something if there's something left over. So, what does this model do? We need to forecast our capital budget. We finance using the target capital structure. And then, if there's any residual earnings left over, we distribute those. This minimizes flotation costs and also supports the lowest weighted average cost of capital. For example, if a firm earns $140 million but only needs $112 million for investments, the $28 million excess can be distributed. But if they had needed $160 million for investments, since they only had $140 in profits, they would reinvest all of that. That would be going to retained earnings. But then the remaining $20 million would have to come from new equity distribution. So this model emphasizes reinvestment first, distribution second. So we need to determine the investments we need to make in the next year. We also need to establish our capital structure. The assumption is that we always gather funds based on our capital structure. So the first thing we need to do is multiply our structure by the capital budget to determine how much equity we need to raise. Take the net income minus, again, that target structure times the capital budget. That will tell us how much equity we need. The distribution then is the net income minus that required equity. So if the number is positive, we pay dividends. If it's negative, we don't. So again, this provides a very structured process of figuring out how to pay dividends. So here's an example of a company that has 3 potential net income levels. The capital budget's 112.5. They typically finance with 80% equity. So if they have 112.5 million in capital budget, 80 million of that is the actual amount of equity they need, or 90 million. In the first example here, we have 140 in net income. We need 90 in equity. So that gives us a remainder of $50 million to be paid out in distributions. 50 million divided by the 140 gives us a payout ratio of 35.7% and a 50-cent dividend per share. If we don't meet that income level, we only have 90 million. Again, we needed to have 90 million in income. We need 90 million of capital budget. That means there'll be no distribution paid. If it's 160, again, we'd have 70 million paid in distribution. So our payout ratio would jump, as well as the dividend per share. Now, the dividend payout here is dependent on the net income and the capital budget. This adds a huge level of uncertainty to shareholders. And of course, shareholders do not like uncertainty. So what are the advantages and disadvantages of this residual dividend policy? It will minimize stock issues and, of course, the costs of that. The challenge is variable dividends, conflicting signals and information. It really doesn't appeal to any specific kind of a client. So as a general rule, we should consider residual policy as a target, if you will, but we shouldn't follow it rigidly. Quite frankly, I think very small, mostly private corporations might use this strategy, but not larger ones. Any company that has publicly traded shares would worry about how investors would react and the impact on stock price. One other piece of information is the procedure, right? The process. So the dividend payments follow a set timeline. There is a declaration date. The statement is published. We will pay a $2.50 dividend on January 10th to all shareholders of record on December 20th. What's the ex-dividend date? Well, this is put in place so that you can't buy the shares at the very last minute and get the dividend. So 2 days prior to the date of record, the price falls by the dividend value. So if the price was $50 on 12/18, the price is going to fall to $47.50. This ensures that the person owning the stock the longest gets the dividend. The new investor can't buy the day before and get the benefit of ownership for the past quarter. And how this really comes about is this idea of the date of record, right? This determines who's eligible. if your name is in the record on this day, you get the dividend. However, historically, it could take 3 or 4 days for your name to get through the process from the brokerage houses to the corporation so they knew who to send the dividend to. That's why this dividend date was kind of set up, if you will. Then, of course, the payment date is the cash distributed on that particular date. So again, that's kind of a short video for this section. Look forward to seeing you next time.